I'd like to ask you, Doug Kiersey, what is the biggest risk?
Um, well, it's interesting. You should ask that question. A question that I ask myself and I ask our team when we're considering an investment is, what does our risk-adjusted return look like? And so I know, or my investors know, if they want to put their money in the so-called risk-free investment, that's also known as a U.S. 10-year Treasury, that presently they can get a return of about 3.7% a year. Well, I'm taking a lot more risk than that. And so what kind of a risk premium do my investors and our company demand in order to take a number of risks? And here are some of the risks. The risk that we build these buildings and no tenants show up. So I'm taking demand risk. There's the execution risk of building the buildings. Can I build them on time and on budget? So I'm taking construction risk, although we try to mitigate that as much as we can. I'm taking interest rate risk because our construction loan is on a floating rate basis. So I have to be able to understand what that looks like over the course of the 3-year construction loan term. Then I'm taking long-term interest rate risk because if I put permanent debt on the project, what is that going to look like 3 to 5 years from now? And lastly, I'm taking valuation risk. So when I create this income stream, when I build these buildings and I lease them to great companies and they pay me rent and I'm creating this massive income stream, what is that income stream going to be worth 5 years from now? And that's really the biggest risk. So I can do all these things and manage all these risks, but I don't really know 5 years from now what that income stream is going to be worth, because a lot of that is reflective of the Fed's activities and where our interest rates going to be. So we try to skate to where we think that puck is going to be in 5 years, but that's the biggest risk in our business. So we can, taking all that into account, when we look at levered returns for a project like the logistics campus in the Chicago suburbs, we're looking for high teens and low 20s kind of pro forma returns with appropriate and conservative underwriting on each one of those stops that I mentioned. And so if my risk-free investment is 3.7% for the 10-year Treasury, and I'm going to do all this, I want something in the teens at least.